So item number 2 in what you should have received from your accountant after your tax filing. So point number 2 is that you should know what your upcoming tax bracket is for the new calendar year and what you can be doing to bring down your tax bracket. Our clients right now have all received a written tax plan and tax summary. So they know exactly what the marginal tax brackets are, and we discuss where they feel like they're going to fall for the upcoming tax year. So we know what their gross income is expected to be, and we know what the net income is expected to be based on last year. The thing that this isn't a difficult concept per se, but it is being drawn to your attention. And then what we want to do is just discuss several ideas that we can implement in order to bring down your tax. And so we'll talk about some deductions that we can implement, but let's talk about some credits too within this section. So here's an example of a person, they reside in Saskatchewan. So the highest marginal tax bracket is 47.5% tax rate if your income is over $201,371. So if somebody is, say, over $10,000 above this income level, they're paying an extra $4,750. So what we want to do is talk to them about the ways in order to bring their tax bracket down in order to save on that $4,700 of extra tax that they're paying at that highest marginal tax rate. So here's some examples of what we would talk about with clients, but I also want to talk about some credits in this section. Credits don't reduce your marginal tax rate, but they're going to save some tax for you as well. So example number 1, the most common and the most simple way to bring down your tax bracket would be to contribute to an RRSP. So if we simply told the client and made them aware of their tax brackets, they could simply take $10,000, place it into an RRSP that would bring them under that marginal tax bracket, and they would save $4,750 in tax. So again, pretty simple concept, but are you aware? The next idea is a credit idea, but if this person resides in Saskatchewan or in a province where labor-sponsored funds are available, and we allocate $5,000 of that $10,000 into a labor fund, this person's also going to save $1,625 of tax. Here's another common thing that I see, and I see this a lot, and again, it's simple, but when I'm reviewing a tax return and I see capital gains and interest or dividend income within the tax return, I immediately check to see if tax-free savings accounts are maximized. You would be surprised the amount of people that have money invested in non-registered accounts and haven't fully utilized their TFSA accounts. So we simply want to completely eliminate paying tax on that income, especially if you're at that highest marginal tax rate. Okay, here's a good one. Again, pretty common, but it's sometimes we just don't think about doing this. So if we see people that have a large savings account, a large emergency fund, or maybe just non-registered assets, and then we know that they have a mortgage and they're paying interest on that mortgage, what we want to do and consider is taking the cash that they have, even if it's an emergency fund, take that cash that they have, pay down the mortgage, and immediately borrow it back and put it back into their investment as their emergency fund. And what we've essentially done is not changed anything to do with how you're invested, where it's invested, what the purpose of it's for, and we haven't changed your debt. All we've done is some steps that would make that portion of the mortgage tax deductible. So if you had $25,000 emergency fund and it's just in a savings account, you're paying tax on the growth, if we took that money, paid it down, borrowed it right back, and invested back into your emergency fund, let's assume you're paying 3% mortgage interest, that would save you, or that would amount to $750 in deductible interest. If you need that emergency fund in the future, no problem. If you use it, we just stop deducting that interest that's deductible. So with emergency funds, I often find people will just sit on it for several years over and over. But if you can save, on this example of $25,000 of emergency fund and borrowing it back, that's $750 in extra tax deductions that we can save. And at that top marginal tax bracket, that's $356 of tax savings. Rental travel, I often see this too. So a lot of people have rentals out there. What they aren't aware of or don't utilize is travel with regards to rental. So if you're traveling back and forth from your house to the rental to check on it or renovate or whatever the case is, that travel expense is deductible. So whenever I see a large rental expense, this is usually due to renovations, which usually means a person's driving back and forth every day or several times a day to do renovations. So I worked out an example. One of our rentals is 16.4 kilometers from our house, and say we did a reno and it took us 2 weeks. So we drove every day for 2 weeks. Let's say we had to go back and check on the rental 6 different times through the year. What this would amount to is 410 kilometers. And so CRA prescribes a rate. So this would save $238 of expense. So I know it doesn't sound like a lot of money, but if we keep adding up 100, 200, all these little hundreds here and there, it's going to amount to a larger number. Another example, and I could go on for a while, but another example that I just want to talk about is home office and home-based businesses. So what I'll often hear and see is, let's say there's a spouse that works out of the home, they earn a high income, and then we've got another spouse that has a home-based business, more so for maybe hobby. They earn $5,000 a year. I've had the spouse say, I don't need to deduct my expenses or my home office because I'm not paying tax anyways. True fact, right, but no, this is wrong. This is the wrong way to look at it. If you earn $5,000, what is happening is you're using up your own basic exemption. So what we want to do is, if we could write down that income to zero if possible, you're allowing more personal amount to be transferred to your spouse. So as much as you are not paying tax and you feel like you're not going to save tax because you're not paying any, your spouse is paying more tax because you're earning an income. So what we want to do is claim home office and as many expenses that you have in order to reduce your income. And I've got an example, and we can put it in the copy here, but if this person who's earning $5,000, if we can write their income down to zero and transfer the full credit over to the spouse that's earning an income versus transferring only the amount after the $5,000 is claimed as income with no expense, this is a tax saving for the spouse of $1,274. So obviously, depending on the income and the expense, the tax savings is different. But my point being is, even though you don't, earn a lot of income, don't pay any tax, we want to make sure we're claiming all the expenses possible so your income earning spouse can save some tax. So just these little amount of examples here that I've presented today, there's 6 of them. I've added it up. So if this was one person with these 6 different amounts that they have, I have added all these amounts. So the RRSP was $47.50 in tax savings. The labor credits were $16.25. With the non-registered assets, let's say you only saved $200 of tax. The mortgage interest example, we saved $356 of tax. And the travel example on the rental was only $113. And then the self-employed home-based business saved $1,274 in tax. So when we add all this up, that's $8,318 in tax savings. That's huge. So that's the big difference between dropping your taxes off, filing them, and not doing any tax review or tax planning. I don't know about you, but I'd like to save $8,300 of tax.